All right, future finance leaders, welcome. Today we're going to tackle a really crucial accounting standard, one that honestly trips up a lot of people. IAS 21, all about foreign exchange rates. Now, if you're gearing up for your SBR exam, you absolutely have to know this inside and out. So let's get it done. Okay, let's just dive right in with a classic scenario. Imagine this. Your company's in London and you buy a bunch of widgets from a supplier over in Tokyo. The invoice lands on your desk and it's in Japanese yen. So the big question is, how do you record this? Do you use pounds or do you use yen? This right here is the exact reason IAS 21 even exists. So we're going to start at the beginning with the absolute basics. We're looking at what the standard calls the single transaction rule. Think of this as your first step, just figuring out how one single company, all on its own, deals with these foreign currency transactions. So for a single company, the rule is pretty logical, actually. It's all about two key moments. First, when the transaction actually happens. You just record it using the exchange rate on that specific day. We call that the spot rate. Easy enough, right? But then you get to year end. And for anything that's still unsettled, like cash you hold in a foreign currency or an invoice you haven't paid yet, you've got to retranslate it using the closing rate. This just makes sure your balance sheet is showing the most up-to-date value. Okay, so that's how one company does it. But for the SBR exam, we're always thinking bigger picture. So let's level up and see how this all works when we bring in group accounts. Specifically, what happens when a parent company has to consolidate a foreign subsidiary. Now pay close attention here, because things get a little different. When you're translating the subsidiary's entire balance sheet, all its assets and liabilities, you use the closing rate from the year end. But for the income statement, all the revenues and expenses that happened throughout the year, you use an average rate for the period. And why the difference? Well, using an average rate for the income statement just gives a much fairer picture of the year's performance, kind of smoothing out all those daily currency ups and downs. So, if you're thinking a step ahead, you've probably already spotted the problem, right? We're using one rate, the closing rate, for the balance sheet, and a totally different rate, the average, for the income statement. When you bring those together, well, it's not going to balance. You're going to have a mismatch, a balancing figure. And the big question, the one you'll get in the exam, is what on earth do we do with this difference? And that question right there brings us to the absolute heart of the matter. This is the core concept you have to walk away with today. Solving this translation difference is a huge focus for the SBR exam, so let's lock it in. Okay, so this balancing figure isn't just some random number. The standard gives it a proper name. It's called the cumulative translation difference, or just CTD for short. It's that exact exchange difference you get when you're translating a foreign subsidiary's financials to create your group accounts. So where does the CTD go? This is so important. It does not go into your profit or loss for the year. No way. Instead, this difference gets parked in a separate little section of equity called Other Comprehensive Income, or OCI. The best way to think about OCI is like a temporary holding pen. It's where we keep certain gains and losses that we don't consider realized just yet. And this is the million-dollar question. This is what you need to be able to explain. Why? Why does the CTD get to bypass the main profit and loss statement? Why isn't it just treated as a profit or a loss for the year? And here is the answer, plain and simple. It's because that difference is an unrealized gain or loss. The key word there is unrealized. Look, you haven't sold the subsidiary. The gain or loss is just a paper-based figure that's bouncing around because of currency movements. It's not a real cash profit, and it has nothing to do with the company's actual day-to-day operations. Okay, so we've got this balance, the CTD, just building up year after year in that OCI holding pen. What happens to it? I mean, when the parent company finally sells off that foreign subsidiary, does that number just vanish into thin air? No, it doesn't just disappear. It finally gets its moment. The process is called recycling, and it's how we finally recognize that gain or loss as being real. The moment that subsidiary is sold, you take the entire CTD that's been sitting in OCI and you reclassify it, you recycle it, straight into the profit and loss statement for that year. It's the final step that shows the total impact of currency changes over the entire time you own the investment. So this right here really sums up the key takeaway. OCI is the place for the unrealized, on-paper gains and losses that build up while you still own the investment. The P&L, on the other hand, is only for the realized gain or loss, the one that becomes real when you actually sell. Keeping these two separate is absolutely fundamental to high-quality reporting. And that brings us to one last thought, a crucial one for you as a future strategic business leader. Why does all this even matter? Well, by separating out these unrealized gains, we give investors and other stakeholders a much truer, much fairer view of a company's core performance. We stop these volatile, paper-based profits from muddying the waters and distorting the story of a company's real, operational success. This isn't just some arbitrary rule. It's a core principle of good reporting, and it's the kind of professional judgment you'll be using throughout your career.